I think if the situation deteriorates in the Middle East, we might see another retest of $4,200 gold, or maybe even 4,000. I actually said this in another interview, in my Chinese language interview, I guess 2-3 weeks ago. I said that. So I fully expect that to potentially happen. I just think, because we did go all the way down to 4,200. I think it's possible to go back to 4,200 and maybe, dip a little bit more than that, which is 4,000. So that's where my numbers come from. It's not written in stone for sure. It can be below 4,000. I mean, like nobody knows how badly the situation is gonna get, and the fact that these swap lines are pretty new. We discussed that. New in the sense that a lot of these swap lines and standard repo facilities were set up after the COVID crisis in 2020. We really don't know how effective they are when push come to shove. I mean, like, of course they're there. U.S. allies can utilize them, but in practice, do they perform really well? Do they react immediate? It can go both ways. Then either the swap lines experience a lot of hiccups, meaning that they don't go smoothly, or they go smoothly, and essentially what it becomes then is it's basically infinite quantitative easing. Is another form of quantitative easing, essentially.
Yes.
Except it's foreign in this case. So, how the swap lines work theoretically is that, let's say these GCC central banks, they need US dollars. They would swap their currencies with the Federal Reserve for US dollar. Like, that's just one sentence, simple explanation. Is, of course, like, the way they actually do is more complicated than. But my point being is, if it goes smoothly and this happens, like, the Fed would put all that foreign currency on its balance sheet, and it will print US dollars and give it to these GCC or foreign central banks. So like back to what I just said, it's just basically quantitative easing infinity.
Right.
Which means if we get to that phase, theoretically, shouldn't the US dollar be devalued at that point? Like, I mean, of course, not measured against the currencies that are being swapped, but against other currencies that are not being diluted. And of course, against things like gold and silver. They immediately reacted with, not QE, QE. That's what they did. So it's very difficult for me to see how they can hold this thing together without doing something within the next quarter. Meaning that potentially, Welsh, the new Fed chair, may actually cut rates, cap the rates where they are, cut it, and potentially might start QE again. Although he said publicly that he's really against quantitative easing. He wants to reduce the size of the Fed's balance sheet. But given the situation that the U.S. is in right now, with the war with Iran, and the fact that things are blowing up in the bond market, I just don't see how he can, keep the situation going without implosion, without also conducting quantitative easing. Now, Danny, there's a way to do that. There's a way, actually. There's an alternative to quantitative easing. And the alternative to that is to revalue the US Treasury's 8,133 metric tons of physical gold from a statutory value of 42.22 US dollars per troy ounce to a value that is closer to the actual market value of gold today, because they are essentially backstopping the gold price. That's what they would be doing if they revalue the US Treasury gold to a closer to market price. But more importantly, Danny, let's say they revalue their 42.22 US dollar per troy ounce, 8,133 tons of gold to, let's say, $4,000, because as I explained, back in the 70s, they didn't do market. They did it slightly below. And the reason for that is because they wanted to keep the physical gold flows neutral. So they do it below. And I would assume that if they do it this time, they would do it below let's say $4,000 if the price of gold is above 4,000. If they do it $4,000, they would be able to get um, around $1 trillion from the Fed. The point is, like a lot of people miss this, Danny, is that if they do this, it's not to wipe out the U.S. national debt all at once magically. That's not the point. The point is if you can pull up the chart that I gave you, explaining is actually infographic explaining the impossible debt situation that the U.S. government is in.
This one?
Yeah, this is the one. If you can make it bigger for your audience. So yeah. So anyway, right now the U.S. is paying around $1 trillion per year for the interest on payment. Interest on debt, sorry. Interest on debt payment is $1 trillion per year. As of right now, of course, like as the debt increases, this number also increases, unless of course they cut rates significantly. Now, if you look at the breakdown, it's on the right bottom side. Yes, so their deficit is actually $1.9 trillion this year, projected this year. So remember, I said if they do the gold revaluation, they get 1 trillion. And if they do the gold bonds, they get another trillion. Well, this will allow them to, first of all, reduce the debt load and also enable them to, at least on the accounting side, they will essentially wipe out their official deficit for 2026. So instead of thinking that these people are trying to solve all their problems in one go, I think, what I just told you, if they were to do it, would give them enough road to kick the can down the road. Make sense? That's I think
that's the goal.
I think that's the goal. I think that's what they want to do. And if they actually do that, they might actually be able to, jack up rates a bit because they have some room. At that point, this would do it because this is something on their balance sheet that is actually of value that they can use without getting further into debt or, ballooning the Federal Reserve's balance sheet. So they can do this, or they can just, like I said, QE infinity, or they can do both, Danny. China does it, but as with anything in the U.S., like the Pentagon, you guys always overspend on stuff. What it takes for China to build, let's say, a cruise missile, it takes you guys, the US, 5-6 times the amount of money. So maybe another possible explanation is just all these data centers being built is part of the tech bubble that is happening to keep the money flowing. Watch his videos in detail, but he talks about how there's a mismatch right now with the need for these commodities and the super low valuation of the miners that actually extract these commodities from the earth in the US, in Canada, and also in the American continent. So I think it's a great opportunity. Like I own a company called Hercules Metals. It has, I believe, the best copper deposits in the American continent and possibly the entire world. Certainly the American continent. And it's sitting at something like 150 million, $200 million market cap. It's basically just, the market capitalization of these companies grossly under their true value. So I in that sense, I agree with Jeff because like a lot of the interviews he keep going on and on about how there's a great opportunity because you're essentially buying stuff that is in some cases you're buying something that should be 10 times the worth of what they're selling it to you. So you have a 10x potential for some of this stuff. So in that sense, I agree with him. And it's the same thing with the energy complex. I'm talking about base power, uranium. I know you own a lot of uranium miners as well. I do as well. And I think the uranium story is not finished because of this AI situation. I think, I said there's the AI bubble. For sure, there's like a bit of overinvestment going on in the AI space, but it looks like AI is here to stay. It's helping me a lot. It's helping you a lot. It's helping everybody a lot. And I think AI is only going to get better. Therefore, this commodity super cycle, as Jeff Curry labeled it, is probably just in the beginning. Like I said, to your audience time and time again, if they don't own any physical gold and silver, it's never too late to start stacking dollar cost average, because we're in this consolidation phase. And just hold on, because like I said, gold might retest $4,200 and silver might retest $64 that we saw, I guess, a
Yeah.
month, 2 months ago.